For individuals that have student loans, the passing of this big, beautiful tax bill could have a dramatic impact on the student loan repayment programs that many people are enrolled in. One of the major things that's going to be happening over the course of the next 12 months is by July 2026, there are only going to be 2 repayment options available to borrowers. And a lot of these programs, like the SAVE program, will be expiring and going away. And individuals will have to transition over to one of the 2 programs, which might be much less favorable than the current income-driven repayment program that they're in now. So in this video today, we're going to be reviewing the details of what's going to be happening. While all of the major tax changes like the SALT cap and tax-free overtime and tax-free tips are getting all the attention, the underlying changes that are going to be happening to student loan repayment programs are going to be major starting next year as well as in years going forward, because starting July 2026, for new borrowers that are entering repayment, there's only going to be 2 programs available. The one is going to be just a standard repayment plan, which includes fixed monthly payments over 10 years. It's similar to the current standard plans, and it's going to be ideal for borrowers with stable incomes who want to eliminate debt quickly. The only IDR, or income-driven repayment program, is going to be something called the RAP plan, which is called Repayment Assistant Plan, which will have monthly payments based on income and family size. Forgiveness is going to be available after 20 to 30 years depending on the loan type, and unpaid interest does not capitalize annual but continues to accrue interest. While there's still an income-driven repayment program through the RAP, there's only one option, and when you compare the RAP program versus some of the other programs that exist today, they're going to be much less favorable, which could result in higher payments as well as a longer time horizon to forgiveness. Now, while July 2026 is the drop date for new borrowers and their options, for individuals that are in current existing IDR plans, those are going to be sunsetting in 2028, which means you may be able to continue into those programs, but at some point you're going to have to transition to either the standard repayment program or the RAP program, because those are going to be the only 2 options available. The current income-driven repayment programs that I'm referring to are programs such as IBR, PAYE, the Repay Plan, and the more recent SAVE program. Any individual that's enrolled in one of the existing IDRs will eventually have to transition to either the standard payback program or the RAP program by 2028. One of the big questions that come up is, will the forgiveness that was part of the other programs carry over and get credit towards the RAP program? We're still waiting guidance from the Department of Education. Now let's specifically address borrowers that are currently in the SAVE program, because this has been one of the most popular programs in recent years, because when you compare it to other IDR plans, it's offered usually the lowest possible payments, sometimes no payments. The interests have been subsidized by the government, and sometimes it offers a faster fast track to forgiveness. The major changes that are happening are, number 1, the SAVE program is not even accepting new applications. Those stopped in February 2026 due to a court injunction, and they haven't said whether or not the program is going to even open up for new borrowers. Number 2, borrowers that are currently in the SAVE program, interest is going to start accruing in the SAVE program loan starting August 1st of 2025. And unless Congress changes something between now and then, the SAVE program will be completely eliminated on June 30th, 2028, which by that time, student loan borrowers in that program will have to transition again to either the RAP program or the standard payback schedule. Another major change that the big beautiful tax bill made for student loan borrowers relates to the taxation of forgiven loan amounts. So there was a special criteria put in place that for the past few years, forgiven amounts have been completely tax-free. That is going to remain true until the end of 2025, but start January 1st, 2026, any forgiven amounts will be fully taxable to the borrower. What that means is if someone was forgiven, let's say $100,000 student loan balance in 2025, they're forgiven the balance and they just walk away tax-free. If that $100,000 isn't forgiven until, let's say, February 2026, now that full $100,000 is taxable at the federal level. So if they're in a 22% tax bracket, that could generate a $22,000 tax liability for that borrower. So they have to plan accordingly for that tax liability. Student loan borrowers are really going to have to reassess what program they're in now, because with the interest beginning to accrue again in many of these programs, with forgiveness now being taxable, with knowing many of these IDR programs are going to end anyways in 2028, they may have to reevaluate if it makes sense moving to a different program ahead of that 2028 deadline. There is also a major change for graduate students coming out of the passing of the Big Beautiful Tax Bill. So previously, graduate students may have been able to take federal student loans to finance their graduate degrees, but now with the passing of the bill, there is a lifetime limit for this graduate federal student loans of $100,000. This applies to all federal programs as well as the Graduate Plus program, which means if individuals have graduate degrees and it costs them $200,000, they may be able to take loans for $100,000, but they're going to have to figure out something else for that $100,000 that's not going to be covered by these federal graduate loans. I think the general theme coming out of the passing of this big tax legislation is proactive planning is going to be required both for individuals that have student loans now as well as individuals that plan to take loans in the future, because this big beautiful tax bill has dramatically shifted the landscape of how federal student loans will work both now and in the future. I hope this information was helpful. This big beautiful tax bill made lots of changes to tax laws beyond just student loans, which is why we created a video series highlighting all the big changes that this tax law made, and I'll include links to those videos in the description of this video below. Thank you for watching.